59 that could well signify that, or signal even, a turnaround, a rebound in the dollar and a little bit of euro and sterling weakness. So in that context, I'm going to look at the cable and look at the prospects of a little bit of a reversal from the rally that we've seen from the lows at 145.65. So let's make a start with the Euro Stoxx 50, and we're going to be using the same chart that I've used for quite some weeks now. It's the daily cash chart, and since the April highs, we've been trading in a significant downtrend, a downward channel. Now on the Euro Stoxx 50, we've broken above that channel. Now cast your mind back a few weeks and you'll recall we saw a similar sort of breakout on the German DAX, but it was not confirmed on the Euro Stoxx 50, and subsequently we turned lower. Now this particular breakout is on the Euro Stoxx 50, but it's not been confirmed on the German DAX. And as with Dow theory, it's always a recurrent theme when I look at markets and look for correlations, particularly in European markets. I like to see a confirmation of a breakout confirmed on both particular markets. Now on this Euro Stoxx 50 chart, we can see that we have broken above the trend line resistance from the April highs, and we've rebounded off the 200-day moving average earlier this month. But if we move on to the Germany 30, the German DAX, we can see that at the moment, the downtrend line, channel line of resistance from the April highs, we haven't as yet broken above it. So I think for any significant confidence that we're going to get a significant rebound in the Euro Stoxx 50, then we'll quickly move back to that chart. If you look at the horizontal line that I've drawn through the May highs around about 3,700, what I would hope to see for a turnaround in sentiment on the Euro Stoxx 50 is a breakthrough 3,700, and that in itself should pull the DAX through its upper resistance line and its pullback line resistance from the break of the downtrend line that we saw in the end of May, the beginning of June. So we're at a very, very key inflection point in respect of the German DAX, because we have two intersecting lines that could well act as a cap for any future gains going forward. So where we are currently at the moment on the German DAX is a very, very key level in the context of the overall direction of the current down move that we've seen since the April highs. I'm going to finish up by looking at the pound against the dollar in the context of last week's Fed rate meeting. We got another growth downgrade from the Federal Reserve, and we saw the US dollar hit its lowest levels in quite some months. But since then, we've seen a little bit of a rebound. And that is somewhat perplexing given the fact that the Fed downgraded its growth forecasts for the second time this year. But given the fact that markets think that potentially this Greek debt crisis or Greek debt story is potentially going to get resolved in the coming days, markets are now focusing on the timing of the next Fed rate hike, whenever that comes. And at the moment, we're seeing a little bit of dollar strength. Now, we can see from this weekly chart, the pound against the dollar, that there's significant resistance between 158.80 and 159. Now, the reason there's significant resistance there is twofold. We've got a 50% retracement level at 158.80 from the highs in 2014 at 171.95 to the lows earlier this year at 145.65. That level around about 159 also happens to be a 50% retracement of that move, as well as being the 200-week moving average. So it's a very, very big chart point. More importantly, given the extent of the rebound that we've seen off the 145.65 lows, is the daily candle pattern that we saw at the end of last week. And that does appear to suggest that we could be in for a bout of some sterling weakness over the course of the next few sessions. If we look at the way those last three candles, which I've circled, have basically coalesced around each other, there is a suggestion that having broken below 158.10.20, we could be in for a little bit of sterling weakness, and the oscillators also would appear to suggest that that is the case as well. We do have plenty of scope to go lower without actually undermining the uptrend that we've been in since the lows that we saw in April earlier this year. So we could certainly go back towards the 200-day moving average, which is the purple line that's basically coming in around about 154.50. And we've also got the 100 and 200, sorry, the 100 and the 50-day moving averages also pointing higher. So judging by that daily chart, there's certainly potential for a little bit more sterling weakness, a bit more dollar strength, but we also have to be aware that there is a significant amount of US data that could affect this sterling dollar move over the course of the next 2 or 3 days. We've got US inflation data out on Thursday. We've got the final US GDP revision out on Wednesday. Either one of those data items could be equally dollar supportive or dollar negative. But overall, I still think that the pound against the dollar will likely remain in its current uptrend, but there is certainly scope based on that particular chart that we could well see a move back towards 155 initially and potentially 154 and the 200-day moving average. We need to get back above